varies. Okay, it's 7 p.m., so I think we can start. Good evening to everyone. Welcome to the MSc Quantitative Finance. My name is Dr. Sami. I will be co-instructing this particular module. This is QF5209, Financial Derivatives, Modeling and Computation. And Dr. Daniel will be co-instructing. So he will not lecture today. I'll introduce the course today. But starting next week, for 6 weeks, you'll be with Dr. Daniel. And then I'll come back in for the last 6 weeks after that. Okay? So I guess you're all here because you're on the MSc Quant Finance program. And QF5209 is a core module, right? Which means you have to take this class, which means that this is all foundational material. Right? So everything that we're going to cover over the next 13 or so weeks is kind of considered very foundational, very sort of core concepts for quantitative finance, especially if you're looking for a career in financial derivatives, quantitative finance, risk management. Then everything that we cover here is pretty much key. So we will have about 40 hours of lectures. 40 hours of lectures will be in this room every Thursday from 7 p.m. The slot is from 7 to 10. We don't have to use the entire 3-hour period, but that's a little bit depends on you. With the one exception, there is an announcement I want to make, which is that the session on the 23rd of October is cancelled and will be replaced by a session on Saturday, November the 8th, 2 to 5 p.m. in this lecture theatre. If that causes a problem for anyone, just let me know. It will still be recorded, and you will have an opportunity to join in possibly the other class. But that's the plan at the moment. So if this causes a big problem for anyone, then please let me know. Okay, but that aside, the typical format of this session, every class will be, I'll try to speak for about 50 minutes where I deliver the lecture, inundate you with information, then we take a 10-minute break, come back, another 50-minute session, which is just really giving you knowledge, another 10-minute break, and then the last session will be really a chance either for you to ask questions or a kind of a recitation where we'll discuss homework assignments, lab assignments. It's really a little bit entirely up to you what we do in that last session. But in terms of this course more broadly, you can think of this course as having 3 components. Okay? And by 3 components, I don't mean that we're 3 parts, part 1, part 2, part 3. I mean there are 3 kind of angles to this course. One is the financial aspect, okay, because we're basically talking about financial derivatives. We're applying our knowledge to the field of financial markets, economics. So there's a financial aspect. There's certainly a mathematical aspect. We're in the maths department. This is a MSc Applied Maths course, if you want to think of it that way. So there's a heavy mathematical element. And then there's a numerical element. And numerical means software. Okay? The mathematical problems that we will face are complicated enough that you will often need to write software to solve them, right? To extract the final answer, the final number. And for those of you who attended the orientation, the speaker from DBS basically had a version of this diagram on one of their slides, which is to show that we are going to sit, we as quants in general, in industry, and certainly you over the next 13 weeks as you do this course, you will sit at the intersection of 3 different fields. Okay? There's the economics, financial markets. The problems that we are trying to solve all come from economics. They're all problems in economics. Okay, so you have to understand some economic theory. And we'll cover that, right? As we go along, we'll cover that. Translating that problem into some mathematical formulation is the modeling aspect of this course. Okay, we'll talk a little bit in a few slides what we mean by model. Okay, but translating that problem that you've understood in economic terms into a mathematical framework is the modeling aspect. Okay, extracting an answer, because often if you're in a bank, client calls you up, they need a price, you need to give them a number. Okay? There's no point having all these models if you can't give the client a number. And usually the models are solved, as I already mentioned, they're complicated models, and you solve them through some sort of computer program, not always, but often, to arrive at a numerical solution. But that step is the numerical aspect. And it's iterative, right? It goes round and round, because you have to look at your answer and think about whether it makes sense. And we'll already start looking at that a little bit today. Okay? If you get a negative number, and you're not expecting a negative number, there's a problem. If you get hash and A, you definitely know there's a problem. Right? It means your code's bad. If you get a number which doesn't make sense, it's too big, either your mathematical formulation was wrong in the first place, or maybe your implementation was wrong. You don't know. So basically you go round and round this, let's call it a vicious circle. Okay? And you will experience this in this course. A lot of the homework assignments, probably all of them, the lab assignments, involve elements of coding, which means that you're going to have to go around this vicious circle yourselves. So just to give you a bit of background on myself, I'm a part-time member of the faculty here at NUS. This is the third or fourth time I'm teaching this course, so I've come to appreciate the parts that students struggle with, that you need help with. So don't worry, I'm here to support you. Okay? All I ask is that you attend, participate, do the homework, challenge yourself, and ask questions when you can. Okay? So I've been in the industry for about 20 years. My background is a quant analyst. I did a PhD in quantitative finance, and then I worked in banking for a number of years. I worked as a trader for a number of years here in Singapore, and then I am now working as a quantitative analyst, risk analyst in a hedge fund. Okay, so I've seen the buy side, I've seen the sell side, I've seen the front office, and I've, in the last few years, also seen a little bit on the academic side. Okay, so I'm going to try to give you kind of a holistic exposure to financial markets, both in terms of the course material, but also a little bit about what happens in the real world. Okay? All right, so in terms of this vicious circle, it is challenging. Okay? It is not easy. Having to sit at the intersection of these three fields, each of which you could have done a degree in, right? You can do a degree in economics, you can do a degree in maths, you can do a degree in software engineering. In of their own right, they're all complicated by themselves. So having to sit in the middle and jump between them is not easy. Okay? That's what quants have to train themselves to do. You could be talking to a trader about something that's happening in the market, some piece of economics. Next thing you know, you're debugging code because the numbers don't make sense. And on the side, you're working on the next model. Okay? It's very typical. You have to jump across these three different fields. And it's not easy. It's difficult. Okay? But I'm not saying that to scare you. I'm just saying that you have to be prepared. Okay? And part of this course material is to prepare you to get to that stage. Okay. So before we start, before we do any maths, before we do any economics, certainly before you type in any code, we need to just take a moment to understand why you're all here. Okay? So what is the case for financial modeling? Why are they important? Why is it so important that it's actually a key core module for this program rather than an elective, for example? Okay, what's the deal with financial derivatives? And the answer most people will give you is because it's a big market. Okay, they'll say it's a very big market, it's important. And that's true, but I want to help you appreciate what that means, right? What is big? Okay, when we say that the market is big, what does that actually entail? What does it mean? So how do we measure the value of something? Well, we put a dollar number on it, right? So let me just start by asking a very broad question. What to you is a big dollar number? What is a big dollar number? Is $1 million big? Come on, it is, right? No, nobody's admitting to it, but it's a big number. It's a big number at your scale, right? $1,000 is a number you understand, right? You budget at the level of $1,000. You go out, you buy your iPhone. You understand $1,000. $1 million is a bit of a step, but I'm sure you can understand $1 million. And at some point in your life, you buy a house, especially here in Singapore. Bet your life you're going to deal with orders of magnitude of $1 million. Okay? But we're talking about financial markets. So what is a big number? How do we characterize something that's big when we're talking about a financial market? How about corporates, corporations? What is a big corporation? And how would you attach a number to it? Any ideas? Well, big corporation. I'm sure you have ideas. NVIDIA. That's a very good one. How would you measure the size of NVIDIA?
Trillion.
Trillion. But what are you measuring? Revenue? Are you measuring? What are you measuring?
Revenue is the AI industry is also.
Okay.
Market capitalization.
Okay, somebody said it here already. Market cap is a good one. Market cap is basically the value of a company. Okay? It's the value of all its assets, all its property, everything. That's the value of a company. So NVIDIA is a good one. What would you put down as the market cap of NVIDIA? Big number. Well, before we talk about NVIDIA, let me ask you a different question. We talked about 1 million. How many zeros are there in 1 billion? 9 zeros? I'm seeing a lot of people say 9. But it's a big number, right? It's a number you don't really understand. And maybe for some of you, you have to stop and mentally count how many zeros there are, right? That's usually a sign that you're dealing with a number that's outside the realms of your natural understanding. Okay, so 1 billion is a big number. How does NVIDIA fit in? NVIDIA is it's moved a lot in the last couple of years, but at this point in time, it's probably worth about $4 trillion. Trillion. How many zeros are there in a trillion? Okay, so now you're already counting, right? You're figuring out. It's an astronomical number, right? It's a huge number. Okay, so NVIDIA, it's big. It's recently a big company. But what about some others? Any ideas? I need one more. People always mention NVIDIA and this other guy. Which one? I didn't hear that. Tesla, okay, that's another big one, yeah. Microsoft, that's another good one. Apple, okay, you're all talking about tech companies, okay. Maybe it's a sign of the times. But yeah, all these tech companies are huge.
MicroStrategy.
MicroStrategy. Oh, I don't know that one.
I mean, MSTR is a very big Bitcoin.
Okay, Bitcoin company. Okay. Is it at the level of Apple? Really? Okay, I don't know. Maybe. Okay, so Apple, NVIDIA 2 trillion, NVIDIA 4 trillion, Apple is about 2 trillion. Google, Microsoft, Amazon, these guys are all around the 2 trillion mark, right? Huge companies. Another one I like to bring up is Saudi Aramco. Have you guys heard of the company Saudi Aramco? It's the Saudi Arabia state-owned corporation that generates all the oil, right? Owns all the oil. It's a big company. That's also around 2 to 3 trillion. Nobody really knows because they're very secretive. And as I mentioned, it's owned by the Saudi government. But I hope you're getting an idea of the order of magnitude. 1, 2 trillion is a big, big company. Okay, these are companies that are not only big, these are companies that have basically revolutionized the world. Okay, Apple has changed the world with their iPhone. NVIDIA is changing the world because they produce the AI chips. Saudi Aramco, company which owns the taps to the most precious commodity in the world, oil. Okay, revolutionizes the world, right? Without oil, where do we get our energy from? But to kind of help you understand a little bit more, because we're talking about orders of magnitude, would you say Toyota's a big company? Absolutely, right? Toyota's a very well-known company. We all see their cars, we've heard about them, it's a very well-known company. How do you think that compares? It's about 2 to 300 billion. Okay? 0.2 of trillion. 0.2 to 0.3. Nike, big company, right? We see the swoosh everywhere. Huge company. We all buy their shoes and the apparel. It's about 100 billion. 0.1. Okay, they're big companies, but I hope you see that compared to the tech giants, this is rounding error. Right? So why am I doing all this? Cut to the chase. Okay, so now let me give you an exercise, just hypothetical. We're not actually going to do this. Say I asked you to list down the top 50 companies you can think of, the biggest that you can think of, and then write down a market cap value next to it. Okay, so we've talked about the big ones. We've talked about NVIDIA, Microsoft, Google, etc. Top 50, top 100. And think about what do you think you can come up to if you tally the market cap? Just add it all up. Hope it's obvious that there, the 1 trillion mark, there aren't that many companies at that size. Very soon you're down to the Toyotas, Apples, not Apples, Nikes, etc. So what do you think you can come up to? 50 trillion? Maybe? That's if you come up with 50 companies worth $1 trillion. Okay, how many zeros are there in 1 quadrillion? Has anybody even heard of the term 1 quadrillion? It's the next one up after $1 trillion. So it's another 3 zeros. 1 quadrillion. Okay, it's like 500 Amazon companies. Right? 1 quadrillion is the size of the financial derivatives market. Okay, so that's what we mean by big. All right, so when I say the financial derivatives market is worth about 1 quadrillion, it's a little bit less, but orders of magnitude, that means that there is $1 quadrillion worth of cash that various investors, companies, speculators, whatever you want to call them, have invested or tried to protect using financial derivatives, using the financial derivatives market. It's astronomical, right? It's the biggest market that people either don't talk about or are unaware of. Okay, it's a big, big market. And financial models are the foundation of that market. Okay, that market could not have grown to the size it is today without financial models. Because financial models help keep track of the value that investors have in the market, invested. They help companies take on more risk, offload risk. Without financial models, it wouldn't have happened. Okay? It's the accounting. The financial models give you the accounting, are the accounting, in a sense, for the financial derivative market. 1 quadrillion. Okay? And we're only talking about financial derivatives in the sense of the valuation. Financial models also come along if we talk about risk measurement. Okay? Okay? A lot of companies who are invested in financial derivatives need to know how much of their capital is at risk. We use financial models for that, value at risk models. And I guess some of you will be taking a course in risk management. I think it might even be a core module, I'm not sure. But you will come across things like value at risk and risk management at some point. They introduce their own models. We won't look at them in this course. Machine learning models have come on the scene. People are using machine learning models to try to look for dislocations in the market, look for trends, try to estimate or forecast where things might be. Not so big anymore. Crypto is essentially a model for a monetary system. Right? It's an alternative model for what money is. Okay, so all of these models are part of financial modeling. But in this course, we're only going to be looking at the financial derivatives aspect of it. Okay? So here are just a few charts to show what I mean. This one is probably the most useful. The red line is the total, what we say notional. Okay, notional is really represents the capital that somebody's trying to protect using financial derivatives. Red line, so you see it's like 700 and growing. It came down a little bit in 2016, but then it's growing up. Interesting to note that a large chunk of that is interest rate derivatives. Okay, we will talk about interest rate derivatives probably in the last two sessions of this module. But there is an elective, if those of you are interested in learning more about interest rate derivatives and credit. I think QF5209 is offered, which allows you to look into that in more detail. So you could spend 30 hours just looking at interest rates and credit risk. We'll probably spend 3 hours or 4 hours in this module. Okay, so I want to give you a set of prerequisites for this program. And I'll disclaimer right from the beginning. It is very, very unlikely that anybody will meet all of the prerequisites. Okay? This is an idealized list. I'm trying to give you a sense of what you need to know if you come from one of the different channels. Right? I mentioned there are basically 3 channels: economic stream, math stream, software stream. Okay? So don't panic if you look at all this and you think that there are a lot of gaps. I would be surprised if there weren't. Okay? At the same time, if you look at it all and you think, I don't know any of it, you've got some catching up to do. Okay? And you need to start earlier rather than later. And the reason that this is a very diverse set of prerequisites is because, in my experience, the audience, you guys are all diverse. So let me get a sense. How many of you come from a maths background? Pure maths, applied maths? Hands higher. Okay. How many are from an engineering background? Civil engineering, mechanical, petroleum, whatever. Okay. Computer science? Software, computer science? Okay. And what am I missing? Economics, econometrics. Okay, so it's very mixed. Okay, you're a diverse audience, which means that as an individual, you're going to face challenges. You're going to have different challenges compared to the person next to you. Okay? And it's an opportunity for you to work together. So as part of this program, I have no problems with people working together. In fact, I encourage it. For the lab assignments, for the homeworks, they're not graded. So just work together. Get together in groups. Maybe one of you is an expert in software, one of you is an expert in maths, one of you understands a little bit more about the economics. Work together, right? Because you're going to have to learn and relearn and go through that vicious circle together. Okay, so here it is, an idealized list. First and foremost, if I would, and this is kind of in order of importance, I would say, calculus. Okay, the course is very, very heavy in calculus. Everything that we do really stems from calculus. If you come from a physics or engineering background, this should be natural. You may need to be reminded, but this will be quite natural to you. So we'll be doing, everything essentially that we're doing is going to be an integral at heart, right? We may solve it in different ways, but ultimately, if I write down something like this, you should know exactly what I'm talking about, okay? If I go back and make it a two-dimensional integral. We're now integrating over some region A. Should also be comfortable with that. Because where we're heading, what we will need is essentially a multi-dimensional integral, dx1, dx2, dxn. If I say xn, okay, if I do something like that, that's essentially what we're aiming to. F is still a scalar function. We're not doing any vector calculus here. Scalar calculus, but it's multidimensional. Okay, so this integral should be natural to you, and I hope it is. If not, brush up on it. For some of you who haven't seen it in a few years, you probably just need reminding. So do that before we actually start getting stuck into the calculus. Ordinary differential equations, partial differential equations. If you're, again, from an applied maths background, and maybe even computer science, you probably would have seen ordinary and partial differential equations. How many people here have come across ordinary differential equations? Okay, good. Partial differential equations? Usually a little bit less, but okay. The key theme, the most important, I guess I'm biased, but I would say the most important equation in financial engineering, if not in finance, called the Black-Scholes equation, is a partial differential equation. Okay? It looks very similar to this guy down here, plus some added terms, but it's basically something like this, right? A scarier version of that. Not too scary. Okay? So if you're comfortable with what that means, then mathematically speaking, you're ready to tackle the Black-Scholes equation, and you can spend a bit more time thinking about the economics that gets you to the equation. Okay, so I'd advise you brush up on partial derivatives, partial differential equations, with ordinary and partial differential equations, both of which will come up in the course. You have to be comfortable with the idea of boundary and initial conditions. Okay, it's a natural extension of an integral. If you're presented with an integral you need to solve, you need an initial condition. This is nothing else, nothing different here. So that's the calculus side. Number two, everything that we do extends from probability. Okay? Financial markets are random, which means we have to use random variables. We have to talk about probability distributions. We have to talk about the idea of an expectation of a random variable. How many people here have done some probability? So if I mention the Gaussian distribution or the normal distribution, that you've seen it and worked with it before. Okay, that's good. If not, then maybe spend a little bit of time getting up to speed with what that is, the properties. Next week, Dr. Daniel will introduce probability theory, just the basics, just what we need. But things like the law of large numbers, the central limit theorem, very central. Right? The law of large numbers just says that if you take random variables, you add them up. As you add more and more together, the total kind of gets close to the mean times the number of variables you've added. Okay? Basically says that the high values and the low values cancel each other out, and you get something that's very close to some multiple of the mean. That's the law of large numbers. The central limit theorem is an even more powerful theorem. It says that the mean, right, if you take the mean of your sample, it comes from a normal distribution, which is quite remarkable if you think about it. That's why the central limit theorem and the normal distribution are so important. It's because it comes up in nature all the time. Okay? In quantitative finance, we use the Gaussian distribution as the central source of randomness. Okay? The bell-shaped distribution. So next, you've got maths, we've got the calculus, we've got the probability, which works with the calculus when you're dealing with random variables. If you need to take an expectation, it's basically an integral. That's where the calculus comes in. Very often, these integrals are complicated to solve. Or generally, the numbers, the mathematical problems that we have might make sense conceptually, but to actually come out with a number, they're very complicated to solve. So everything we do will be implemented using some sort of numerical methods. Okay? And the first half of this course will really focus more on the numerical methods. We'll basically cram all of the numerical methods into you in the first 6 weeks. And then the next 6 weeks is more about using your suite of numerical methods to solve more and more complicated types of derivatives. Okay? So the idea of solving integrals numerically, if somebody gives you this integral to solve from a to b, f is very complicated. You've all seen the standard Euler discretization. You break it up into little rectangles, and you take the sum. Okay? Very basic. We're going to do things that are a lot more complicated than this, but the idea of numerical methods to discretize an integral, especially in high dimensions, that's what we're going to focus on. Okay? Standard root finders, things like Newton-Raphson, bisection. If you've done engineering or applied maths, you would have seen that in quite earlier on in the program. And linear algebra. So we will do a little bit of linear algebra here as well. Nothing too complicated. You have to be comfortable with the idea of a matrix, of a vector, of a linear system of equations, right? Which is often written as ax plus b equals 0, where x is a vector, b is a vector, a is a matrix. Okay? This will come up when we look at finite differences to solve PDEs. So you have to be comfortable with the idea of linear algebra. Once you get to this point, it's easy. Okay? X is just, right, something like that. So you're not going to spend time on this bit of maths. The thing that I want you to spend time on in this course is, well, what is the matrix A? What are the values that go into it? Okay? What is the vector B? What are the values that go into it? That's really the point of this program. Once you get to that stage, the computer will do the rest. Okay? But you have to know enough about linear algebra to be able to assemble these objects, these matrices and these vectors, so that you can then code up the computer to do what you need it to do. Okay, so there's a little bit of linear algebra. In terms of computation, so that's the maths, right? Calculus, probability, numerical methods, getting towards applications. You need to be able to construct simple algorithms. Okay? And trust me, you want to do that for more than just this course. For those of you who are going to go and interview with quant companies, banks, hedge funds, fintech companies, algorithms are going to come up all the time in the interview process. Okay, so you need to basically be able to think algorithmically, not only for this program, but I'm preparing you for the future. The first stage in any interview process will be to do an online test. Okay, I'm sure, have you been through that process already? Some of you? Okay, some of you are nodding. So you know what I'm talking about. So you have to be comfortable with the idea of an algorithm. Right? And in a few slides, we'll talk about precisely what an algorithm means in this course. But more generally, big O notation. How many people here have come across big O notation? Okay, so big O notation is another important one to assess the efficiency of your algorithm. You know, is it order n? Is it order n squared? Log n? You need to be able to do those kind of analyses. And in things like the midterms or the final exams, that's really how I'll test you. I won't ask you to write code for the final exam. You may need to write pseudocode, and we'll talk about what that means in a few slides. But more important than actually writing the code for this course, it's the ability to be able to dissect and analyze your own algorithms, your own code. Okay, and I emphasize that at the stage of coming up with an algorithm, you don't need a computer, right? Construction of an algorithm, analysis of an algorithm, you do that at your desk. You don't need a computer. You're doing it on pen and paper. Okay? Once you want to implement your algorithm, once you're clear as to what you're trying to do, you're going to implement your logic using a programming language. And for this course, we're going to use Python 3. You're not forced to use Python 3, but I encourage you to solve all the problem sets in Python 3 because my solutions will be in Python. So for you to be able to compare, and you absolutely should step through the solutions to understand how I've implemented my code versus how you've implemented it. That only works if you're working in Python. How many people here have some coding experience? Okay, how many people here have coded in Python? Okay. So for those of you who have not, don't worry. We're not going to use, or the intention is not to use the very advanced features of Python. That's not the purpose of this course. We're going to use the most basic features of Python just to extract a number out, to get a solution. Okay, I'm not interested in elegant code. I won't penalize you for doing things in a messy way. A software engineer might say it's too messy, it's not elegant. I won't penalize you. As long as it's correct numerically, I'm good. Okay? So all you really need, frankly speaking, is for loops, conditional statements, and the ability to step through code and debug what's going on. Right? That's all you need. You're welcome to introduce object-oriented programming. You're welcome to do it in C++ if you wanted to, but it won't get you points. Ultimately, I just need the number. And I need to know that you've implemented it in the most efficient way. Right? That is to say, your big O notation has to be optimized. Okay, so I really urge you to pick up Python for two reasons, really. One is, here's a chart that shows usage of Python based on how many questions people ask. How many people here use Stack Overflow? Okay. How many people here use ChatGPT? Okay. No, it's good. You're absolutely welcome to use ChatGPT. You won't have ChatGPT in the exam, but you can use it to solve, to ask questions to understand how the code works, to help you figure out what you're trying to do. 3 years ago, before people were even using ChatGPT, most people were basically going into Stack Overflow. And you can see here, Python is the orange one coming up, JavaScript tapering off, C#, once the master of the universe, tapering off. C++ is kind of coming down, but C++ isn't going anywhere. There's just too much written in C++. This only goes up to 2020, so I updated it. You can see quite clearly Python is just up there. Okay? So in terms of just general usage, Python is it's just left the competition behind. Okay? I'm not saying it's the best. I'm saying that, look, you're all going to fall into one of two camps. Either you're going to do a bit of coding for this course, for this MSc, and decide, you know what, I never want to do any coding again in my life. And that's okay, because if you pick one program, it may as well be Python. Or you're going to love coding, you're going to go into the quant sector, maybe into the software sector, and you're going to have exposure to many, many different programs. But believe me, Python will always be there somewhere. So you might as well pick it up. Okay? Whichever way you look at it, Python is going to be useful. And for some of you doing the machine learning module, I think there's an elective machine learning with quantitative finance. I'm pretty sure you're going to be using Python there. Okay, all the machine learning packages are basically written in Python. Here's just another chart, shows job openings where Python is mentioned. You see pretty much 15% of all job openings, software engineering jobs, mention Python. I mean, there's so many programming languages out there. Python comes up 15% of the time. It's quite remarkable. Okay, so get up to speed with Python. Professor Daniel might give you a quick overview of Python next week, but you don't need to wait that long. Go onto YouTube. There are many, many courses, many courses which help you learn. Tutorials, everything from 1 hour up to 24-hour courses. You don't need to do 24 hours. We probably need a 5 or 6 hour course to get the basics. If you're not set up with Python already, do so. Starting next week, you will have the second problem set, which goes out next week, is a coding problem set. Okay, so there'll be a problem set going out today or tomorrow. Won't have any coding. But from next week, all the problem sets basically involve some coding in Python. So you might as well get up to speed with it. Yeah, and this is just saying what I've already said. So Python is easy to pick up. It is easy. It's much, much easier than most other programming languages. There's a huge library for scientific computing, a huge support community. You may hear people talking about the downsides, that it's a bit slow. It's an interpreted language. Yes, maybe, but we're not bothered about that level of efficiency. We're trying to solve problems that we can't solve on pen and paper. Okay, so if you get a number out in a few seconds, it's good enough. Some people say the days of Python are numbered, other languages coming on the scene. A couple of years ago, I thought maybe. Now I feel differently. I don't believe it. I think there's just too much good stuff in Python that it's going to stick around, right? And the statistics we saw basically support that. Okay, I'll give you an idea of the syllabus. Oh, one more. Prerequisites, economic prerequisites. This is the least onerous. You just need to understand a few concepts, which we'll talk about, but some of you may have come across them already. First is the idea of a free market, right? Free market means a market where you're allowed to buy and sell at free will. Nobody stops you. As long as you're not breaking the law, it's good. Okay? Efficient market means that every time you do want to trade, there is somebody to trade with you. Okay, you want to buy a stock, you assume there exists a seller. Not necessarily true, right? It's not necessarily true. And investors act rationally and optimally, which is to say that investors act in their own interest. Okay, they do what's best for them. And those are the assumptions that we will be working with in this module. They're reasonable, but they don't always hold. Okay, and something we'll talk about later on after we introduce Black-Scholes, when we talk about some of the shortcomings of Black-Scholes, we'll come back to these concepts, right, and how we adjust for them and what the implications are. But in terms of the real economic prerequisites, I would say follow the financial news, right? Invest time to understand what's happening in finance, what's happening in the markets. Very often, what happens in the markets drives the financial models that you want to use. Okay? It's not a case of one financial model works all the time for all assets. Okay, Japan had negative interest rates for 30 years, and everybody was using the same type of model. Japan was an outlier. The models that people used for the Japan market were different to what they use in Europe, the US, etc. Towards the end of last year, or mid last year, as it became clear that the Japanese Bank of Japan was going to increase interest rates, everybody did something they hadn't done in 30 years, which is to change the model they used for the Japan market. Okay? So you should be aware of what's happening in the financial news, because as a quant, you own the model. You have to know when it's valid to use and when it's not valid to use. Not only from a theoretical perspective, but from a kind of a real-time market-relevant perspective. Okay? Markets are what drive the models that we use. All right, the syllabus. So the syllabus is in two parts, broadly speaking. So what I would call a foundational part. Okay? And this is really the core material. Okay, and we'll start talking about some of them today. We'll introduce the idea of replication today. I'll introduce the important definitions today. Next week and the following weeks, Dr. Daniel will introduce the idea of the normal distribution and the log normal distribution in the context of quantitative finance, in terms of modeling. And all that is leading up to the Black-Scholes PD, which is, as I've already mentioned, is the most important equation in finance. Actually, the authors of that equation won the Nobel Prize in Economics, right, for the Black-Scholes PD. And you'll then look at solving the Black-Scholes PD to extract a number, to extract a value. Basically, the Black-Scholes PD models the value of a derivative. And if you solve it under certain conditions, you get the price of the derivative, which is ultimately what the client wants. The client rings up the bank, says, make me a price for option on XYZ, expiring so-and-so. You run your model, finite difference or Monte Carlo, depending on the terms, depending on what the payoff is, you get out a number. Okay, that's part one of the course. Really coming to terms with the Black-Scholes equation, understanding all the assumptions, all the modeling. You can't credibly say you've done a course, an MSc in quantitative finance, without this stuff. Okay, it's core material. That's part one. Part two is what I would say the more advanced part of the course. It picks up where part one left off, but any advanced course in quantitative finance, some of the other electives, will probably start with something called the risk-neutral framework. Okay, and I'll introduce that to you. It's basically a natural extension of a framework to price derivatives. Okay, most advanced courses start here. And then we'll talk about multi-factor derivatives. Okay, these are derivatives where you've now got multi-dimensional problems. From a mathematical perspective, it's a multi-dimensional calculus. We'll talk about some advanced Black-Scholes concepts. As I mentioned, some of the economic concepts that were maybe weak assumptions. We'll talk about hedging, implied volatility, and then we'll introduce the idea of a stochastic volatility model. Right? One of the big shortcomings of Black-Scholes is that it makes very simplistic assumptions on something called volatility, which we'll introduce. And then we'll talk about FX and quanto derivatives. These are kind of more exotic type of derivatives. By exotic, I mean funky, specialized, not the everyday type. And we'll have probably just 3 or 4 hours at the end to talk about interest rate modeling and credit risk, just to introduce the concept to you. Because once again, I think, although it's too much to ask in this course for you to become an expert in interest rate derivatives, I wouldn't be doing you justice if I didn't even bring it up at all. Okay, so you'll see the absolute basics, but enough for you to understand and decide whether it's something you want to pursue further. And I think I've already mentioned this already. Weekly lectures in here, except for the 23rd of October. Weekly homework, right? So there'll be almost weekly homework. And the way I plan to do it is I will normally release the slides for the lectures one day before the lecture. At the end of the lecture, so either tonight or tomorrow, I'll release the problem sets and some supplementary reading. And the solutions to the problem set will be released a week later. Okay, so you'll have about a week to work on them. You'll have the following lecture session to ask questions if you want to ask specific questions. I encourage you to ask your questions publicly. If you have a question, I guarantee you there's at least 5 or 10 other people who are thinking the same thing. If you don't want to do it verbally, you can use the Canvas portal. There's a discussion board. That's a good place to ask questions and discuss with your colleagues. I'll chime in as well. But be prepared to participate in the problem sets. You really, I can't emphasize enough how important it is to attempt the problem sets. That's where you're really going to understand the material. None of the problem sets are assessed. Okay? I don't want to put you in a position where you're trying to earn your marks while you're trying to learn the material. I think that's unfair. So all the problem sets are not assessed, which means you can share knowledge, you can attempt them together. I won't even check if you've done them. Okay, I will release the solutions, and it's up to you to go through them, compare with your solutions. And as I said, I'm absolutely fine with collaboration. In terms of grading, there will be 2 midterms, and probably one to cover part 1 of the course and one to cover part 2 of the course. The midterms each count towards 25% of the final grade. And the final exam, which is probably towards the end of November, beginning of December, that's worth 50% of your final grade. Okay? The final exam will be in a hall somewhere, pen to paper, no coding. You won't need a laptop, you won't need a device. You'll need a very basic calculator, if that. It'll basically be handwritten. The midterm assessments will be on Canvas. They're typically about 60 to 90 minutes long, and you'll get a week window to do them, and you can choose when you want to do them in that period. But once you start the midterm, clock starts ticking. 60 minutes later, your answer gets submitted. Okay? Only one attempt. And those are all individual assessments. Okay? Everybody gets their own grade. But they're all on Canvas, and they're a combination of multiple choice, simple numerical calculations, pseudocode, which you'll have to analyze, no coding. Okay? So I know I've talked a lot about coding, and you may be wondering, well, that's very strange that you're emphasizing coding so much and you won't even assess it. The reason I'm not assessing coding is because I don't want to spend time, or for you to spend time worrying about syntax, worrying about setting up an environment for your code. I'm more interested in the logic of what you're trying to program, right? And I can test that without making you sit in front of the computer. Okay, so any questions on that so far? Okay, perfect. Let's take a short break. Oh, one more thing. Reading material. As I said, the slides are the main material. There is supplementary reading, a set of lecture notes, which I will make available every week. Other than that, if you feel that you need to, and I'm sure you will at some point, feel that you want to dive in a little bit deeper, there are 3 texts that I recommend. Hull, which is like a Bible, Options, Futures, and Other Derivatives, very well known. It's been used by academics and practitioners for about 30 years, probably. Wilmont's another good one, Wilmont on Quantitative Finance. I would say it complements the supplementary notes quite well. Okay, I think the way he approached it is kind of very similar to how the notes are written. Shreve is another good one, but it is very heavy in stochastic calculus, so maybe not for everyone. But there are parts of the book, and it comes in 2 parts, 1 and 2. There are parts of the book which are relevant, right? If you can get over the mathematical rigor, it's worth spending time on. Okay, but this is an applied course, so don't spend too much time. I wouldn't advise you to spend too much time on the stochastic calculus derivations, the pure maths derivations. There's probably another course, I think, Introduction to Quantitative Finance, where you get to do all that. For this course, it's all about application. Okay. And finally, in terms of other reading, this is not syllabus material, but it is very relevant in terms of quant reading. A couple of books that I really like, which describe quants, the trouble they've caused. When they cause trouble, they're usually catastrophic. So When Genius Failed is a book, non-fiction book, written about long-term capital management, which is a hedge fund that was very well known, made a lot of money, and then spectacularly collapsed. In fact, 2 of the authors of the Black-Scholes model worked at that hedge fund. They helped set it up. The other one is The Man Who Solved the Market. Has anybody heard of Jim Simmons? Renaissance Technologies. Does that one ring a bell? They're well known in certain circles, but they're so secretive that they prefer not to be well known. That book, The Man Who Solved the Market, is kind of like an obituary of Jim Simmons. He died last year, I believe, about a year ago. He was an academic. He was a professor of maths up until the age of 40, 45, at which point he decided to try investing, and he basically invested in the financial markets using financial modeling. right? They made a lot of money, and the fund still makes a lot of money. Their flagship fund, the Medallion Fund, is so secretive that it is only open to the employees of the firm. And it's a fund that makes something like 40% annualized returns. Right? I think in 2008 they made close to 100%. 2020 they made close to 100%. This is a fund that's made astronomical returns, and nobody knows what they're doing. Okay, it's an interesting book. And finally, financial news. Okay, that's the reading material. Right, let's take a short break. Come back in 10 minutes at 8:05. Okay, so introduction out of the way, I think we can start on some actual core material. And the goal today really is just to build some core concepts. So I'll introduce some foundational themes, and the rest of the course will build over these. Okay? But the building blocks, the definitions, which will come up again and again and again, you'll hear about them today. And then I'll introduce some common or vanilla financial structures. So vanilla is a term which means the most traded, the most basic type of derivative products. The opposite of that, the funky stuff, the more complicated stuff is called exotic. That's just some nomenclature. So I'll introduce a couple of well-known, frequently encountered financial structures. We'll talk about the time value of money and discounting. And this is, if you stay in quantitative finance, if you make a career for this, in this field, time value of money is something you're going to deal with for the rest of your life, right? For the rest of your working life. So you'll see it today, maybe not the first time, but for those of you who haven't seen it before, I'll introduce kind of the basic idea of interest rates. And for pretty much most of this program, right up until week 12 probably, we're going to stick with that very simplistic assumption around interest rates, right? For any serious interest rate modeling, if you want to get sophisticated with interest rates, I'll introduce that later, week 12, week 13. But as I mentioned, you can spend the whole semester talking about interest rate modeling. Okay, so we're just going to scratch the surface. And then later today, I'll do a deep dive, a case study. That's kind of today's recitation, if you like, which is a deep dive into forward contracts. Okay, and the forward contract, we're going to introduce it today. It'll be on the homework assignment as well, because it's so important. It just comes up again and again and again. It's actively traded, very popular in commodities. So we're going to talk about forward contracts. Okay, some definitions. First of all, we're doing financial modeling, so what is a model? Okay, I want us to be clear about what we mean when we talk about a model. And this is not just for this module now. This is general, right? We come across models in physics, in mathematics, in engineering, in finance. So what is a model? And in the most simplistic sense, a model is nothing more than a simplified representation of the real world. Okay, so the real world is complicated, a lot of things going on. You can't keep track of everything. A model is kind of like a playground, right? You simplify the real world. You focus only on the things that you think are important. You ignore everything else. Okay, and you work with it. So it's a place where you can make mistakes, trial, experiment, see what happens. If it doesn't work, tear the model down, start again. Okay, so a model is kind of like a precursor to something that's going to happen in the real world. But you want to make sure you get it right in the real world. So you've all come across the idea of a physical model, right? So if you're a civil engineer looking to build a massive bridge, first thing you do is you build a model, physical model, in a lab somewhere. You literally physically put together the bridge, you test it, you simulate cars driving over the bridge, and you see if it works. But it's simplified, right? It doesn't represent the real world. But your model, for it to be good, has to be constructed sensibly. It's got to, for example, if you're talking about the stresses within the material in your model, the stresses have to relate, at least proportionally, to the stresses that the real bridge will be exposed to, right? If your model uses cardboard, it's already going to fail. It's not a model, because the real bridge won't use cardboard. So maybe you decide you put the actual material, bits of concrete, whatever it is, tar, you build the bridge in your lab. The stresses all work out. You simulate some cars going over, everything looks good. You build it, and it works well, and all of a sudden, one hot summer's day, you realize it starts causing problems. It starts becoming dangerous. Why? Because your model didn't factor in temperature variation. Your model was too simple. Okay? So as the author of a model, you have to decide what is important and what is not important. Okay? Maybe temperature is important, wind factor is not important. I don't know. Different circumstances mean you need to make different types of modeling assumptions. So that's kind of the physical model. What we will be dealing with is a simulation model, right? So it's not a physical model, but nevertheless, it's a piece of machinery. It's something that allows us to make an estimate of what will happen in the real world. Okay, and so for example, population growth models. Okay, so back to calculus. That's the standard population growth model. Okay? Is that reasonable? I don't know. You do some studies. What's an appropriate value of B, beta? Can you come up with something sensible? If you're constructing a town, new town, you need to know how the population is going to grow. You need to estimate how quickly it grows so that you can build the roads that need to come into the new town, build the schools, build the hospitals. A very simple, there's a very basic population model which will tell you that this is how the population will grow with time. Okay? Maybe it's too simplistic. Maybe you realize, well, actually, you know, it doesn't factor in people coming in. It factors quite well the people that are already in the town. It doesn't factor people coming in. So you decide, well, maybe I need to add some term here. Okay, that's a slightly more sophisticated model. Okay, it's just a piece of mathematics now. That's all a model is. Simulation model is just a piece of mathematics. So you want to keep it as simple as possible. Right? You don't want to overcomplicate. Simpler models are always better. And this is a nice quote here, which is make everything as simple as possible and no simpler. Right? Which I think is very valid in our case. Does anybody know who that quote came from? No? I think it was Einstein said that. Okay. And as usual, spot on. It's a good quote. So in our case, in financial modeling, we want to get away with as little as possible. We don't want to overcomplicate. Okay? But we don't want it to be too simplistic to the point where it's not realistic. Okay, so that's the idea of a model, and we will see many models in this program. Okay, you'll see models for assets, you'll see models for pricing derivatives. But once you have a model, next question I want you to ask yourself is, well, what is an algorithm? Okay, we've talked about coding and Python, but all that aside, what in essence is an algorithm? And an algorithm is nothing more than a set of instructions. And it goes hand in hand with your model. Okay, so your algorithm has to obey the rules and has to live within the restrictions of the model that you prepared, because it is a set of instructions within the confines of a model. Okay? And in a sense, it's just a set of instructions that anybody should be able to follow blind. Even if you have no expertise in the model, you don't understand, or you didn't come up with the model, the algorithm has to be a set of instructions that you can follow blind and you'll still extract the right number at the end. For example, if we go back to population growth model, this was the model. We didn't say anything about algorithms here. The problem might be to estimate the population in 5 years. Okay? Okay, let's come up with an algorithm. Now I know we can solve this. Well, we might be able to, depending on what f is. Okay, we don't know what f is. But say f is sufficiently complicated that you can't, you know, your maths just won't let you solve it in closed form. Okay, so you solve it numerically. And your algorithm basically says something like x at time t plus 1 is equal to x at time of t plus beta x at time t delta t plus f of t. Okay? That's the discretization. That's still not an algorithm. Okay, the algorithm will be to say, and for example, this is what I would expect in an exam. This is what I would mean by pseudocode. I would ask you to write down the algorithm. I'll definitely be looking for this expression. That'll be a tiny part of the problem. You're going to have to tell me what is a value of delta t. You're going to have to tell me what is x0. That's what starts. You're going to have to tell me to loop through this difference equation however many times to get to 5 years. The algorithm will have to state all of these properties. Okay? I hope you see what I'm getting to. I'm not looking for syntax. I don't want you to write it as if it was Python code. It can be in regular English. It can be in kind of broken code. It can be mathematical, right? There's ways of writing a loop mathematically. You can just tell me, run this 10 times. Keep value of xt each time. And then return the last value of xt. That will be an algorithm. Okay? And generally, when you're doing your coding for the lab assignments, before you start typing any code, make sure you have the algorithm very clearly written down, either in your mind or even better on paper. That's, to me, that always works best. You're very clear what you're trying to do. By the time you're coding, you're just writing down the instructions. Okay, that's what I meant earlier when I said once you have the algorithm, you can just follow the rules blind. Just typing monkey at that point. Okay? At that point, you don't even need to remember why the expressions make sense. Okay? The algorithm has to be something you can present to someone who has no expertise in your subject, and they would still be able to come up with the code. All right? So this is like estimating the population. And you can be sure that there will be pseudocode. Pseudocode will come up in exams, in midterms. That's the way that I will assess how well you understand the problem you're trying to solve. Okay, so more definitions. We've got a few of these to get through, but this is a very, very important one, arbitrage. So what is an arbitrage? It's a key definition. Okay, the whole point of everything we do for the next 13 weeks is attached to the idea of removing arbitrage or ensuring that we do not introduce arbitrage. So what is arbitrage? And simplistically, it's just the opportunity, any opportunity to make a risk-free profit is an arbitrage. Okay? Risk-free profit is the key word. So for example, you've got $100, you invest in some stock, price goes up, you make money. But if the price goes down, you lose money. Okay? So there's a risk. There's a risk. That is not an arbitrage. An arbitrage is an opportunity to make a risk-free profit. For example, let's say you're in the market and you have a broker quoting 10-12 bid offer on an asset. Any asset. It could be a stock. Bid offer means the broker will buy at this price. The broker buys at 10 and the broker will sell. And when I said earlier on that the markets are efficient, there are no restrictions, I'm saying that you assume that there will always be this broker willing to do the trade at that price. Okay? And the way brokers make money is they just buy at 10 and sell at 12. They make $2 every time that transaction happens. That's how they make money. So there's a broker quoting 10-12 for an asset in the market, broker B quoting 13-14 on the same asset. You look at that and you ask yourself, is there an arbitrage? You think there is? Okay, can you tell me?
Well, you can buy at 12, sell at 13.
Correct. Broker sells at 12, so you as a market participant can buy from this broker at 12, and instantaneously sell to this broker at 13, because this broker is buying at 13. And you make $1 profit for doing nothing. You've taken no risk. Of course, I'm assuming that both brokers are available. They don't decide not to trade with you because, whatever reason, they don't like you. Okay, we're putting all that aside. This is an efficient market. And in an efficient market, there's clearly an arbitrage. So you're going to do this trade all day in big size, as much as the broker can give you. And what will happen eventually is that this guy starts figuring out that you keep buying from him, and he's running out of the asset, so he starts to raise the price. And this broker, they realize you keep selling to them, so something's not right. And these two prices start to converge. Okay? Very clearly, there's a dislocation in the market. Two brokers are doing two different things, but as soon as people start exploiting the arbitrage, they start converging. Okay? So this kind of phenomenon, what I've described, does exist, right? And it usually exists in new markets, inefficient markets. For a long time, Bitcoin had these kind of opportunities, especially cross-border. Certain individuals, if they had access to Bitcoin in some jurisdiction, could buy it from that jurisdiction, sell it in a different jurisdiction, and make arbitrage-free profit. So this kind of opportunity doesn't exist in the mainstream market, but it usually signals an inefficient market. But that's an arbitrage. Okay? Mathematically speaking, this is a loose mathematical definition, but it's good enough for now. V is what I will usually call the value of some contract, the value of a derivative. Okay, I haven't explained to you what a derivative is yet. Whatever it is, it has some value. And I will usually denote that as V. Okay? So if the value of the derivative at some time t0, which could be today, okay, if that's less than 0, what does it mean for something to have negative value? What does it mean for something to have positive value? If something has positive value, if a stock, Microsoft, or what is it, let's call Amazon, is probably at around $240, it has positive value. What does that mean? It means if you want to buy a stock, one stock of Amazon, you've got to pay $240. Okay? If something has negative value, that means that if you want to buy it, they pay you to take it. Okay, so that's what V being negative means. So V starts off negative, but you know with probability 1, the probability that V, the value of this contract that you've just bought, at some later date, the probability that it is positive or equal to 0 is 1. Okay, if you have that condition, that's an arbitrage. Because what it means is that today, you buy the asset, but they pay you to take it. And later on, it's going to be worth something positive, so you might be able to sell it, make money both ways. Okay, that's just the mathematical explanation of what I've described. Another one is also if V is equal to 0 today, which means that you can get it for free, whatever the contract is, the value, the derivative. But you know with probability 1 that it will be worth something in the future. That's also an arbitrage. Okay? You get something for free today, and it will be worth something non-zero in the future. And when it is, you sell it. That's your arbitrage profit. Okay, so V is a loose term here, right? I haven't explained what V is. It's the value of the derivative. There's a bit of discounting in there, but leave all that aside for now. Just understand that the concept of arbitrage is the possibility of making risk-free profit. Okay, what is an asset? In this course, more often than not, I will call the asset S of t. T being time, because the value of the asset changes with time. And the asset is something that just exists, right? It's an instrument that already exists. We're not going to worry about it in this course. Quants don't worry about assets, where they came from. Stocks exist. Okay? Nvidia share price, whatever it is, it's governed by supply and demand. It exists. We just need to know that it has a value. And next week we'll start talking about models which determine how this value can change with time, right? That's where randomness comes in. But nevertheless, S of t is the value of an asset, and they are the building blocks for quants. Okay, so an asset could be stock, as we talked about equities, it could be the bonds, government bonds, corporate bonds, they also have value, right? Change with time. It could be the value of a commodity, oil, natural gas, grain, precious metals. They're all commodities that have value. We can represent that by S. In the new age, cryptocurrencies, Bitcoin has a value, varies every day. We're not worried about what that value is and whether it's right or wrong. We accept that they exist, and we try to model them. Okay? The engineering, so that's an asset. The engineering comes in the value of the derivative, right? Which I will call, as I've already mentioned, V. Okay? V of t. Mathematically speaking, it is just a function of time and the underlying asset, and a whole bunch of other things that we will fill in as we get more sophisticated. But for now, and probably for the next few weeks, this is enough. So the financial contract, a financial derivative, is a contract which has some value, but its value depends on some asset. Okay? So the asset is what it is, it exists. The engineering comes in, well, what's the value of this derivative? Its value derives from some asset, and essentially it's a function. Mathematically speaking, it's a function. Okay? And the whole purpose of this course is to figure out what that function is under different payoffs, different conditions. And as I've already mentioned, it's a huge market, which is often in the press for the wrong reasons. Derivatives have spectacularly blown up in the past. A lot of the major market meltdowns were caused by derivatives. Derivatives do a lot of good too. People generally remember the bad episodes. Okay? But the bad episodes, Barings Bank, a very big British bank, I think maybe at the time one of the biggest, if not the biggest banks in Britain. It went bust in 1995. It was sold for £1 because they had amassed huge losses from derivatives, trading in derivatives. And it's interesting because this actually happened here in Singapore. So the trader who was trading at Barings was based in Singapore. He accumulated very risky positions which were losing a lot of money. And with derivatives, I'll talk about that in the next slide, but they lose money very quickly. When things go wrong, they go wrong spectacularly. There's a movie on this rogue trader. Okay? It's kind of an old movie, but it's a very good movie. Describes exactly how it happened. Long-term capital management is another one. A bunch of academics got together. There was a very senior, well-known trader at the top, but essentially he brought together these academics. They started trading in derivatives. They accumulated massive positions in risky derivatives. Things went against them, and they spectacularly blew up. But they blew up in a way that affected every other institution, because derivatives tend to link various banks and institutions together, so that if one person goes down, the effects kind of spill over. Right? And the best example of that is actually the 2008 financial crisis. And if there's time later on, I'll talk a little bit about the background of the 2008 financial crisis. But basically, derivatives caused the 2008 financial crisis. Okay? Misunderstanding of derivatives or inappropriate risk management of derivatives caused the 2008 financial crisis. And these crises usually happen because these derivatives are what we call highly leveraged. Right? So next definition is, what is leverage? And it's a way to make outsized returns. It's to make your money work harder for yourself. Yes, to make your money work harder for you. Okay, so here's a very simple example. Forget about derivatives for a moment. But let's say you have $1 million. Okay, and you go out and you buy a house. Buy a house for $1 million. House price goes up by 10%. In a year, it's worth 1.1 million. You can sell it, and you made a 100K profit, right? Very standard. That's what I would call a times one leverage. Okay. The other thing you could do to make your money work harder, instead of investing your $1 million in one house, you put down payments of 10% on 10 houses, right? House prices still go up by 10%, so the market does the same thing. In fact, 1 and 2 could be happening in parallel, right? Investor 1, Investor 2. So Investor 2 puts down 10% deposits on 10 houses. House prices goes up by 10%. Well, guess what? Investor 2 has made $1 million. Same market conditions, but Investor 2 made the money work harder. Now that's not free, because it comes at high risk. Okay? And what's the risk? Well, the risk is the house prices could go down by 10%. If house prices go down by 10%, Investor 1 loses 10%. They still have 900K. Investor 2 is wiped out, lost all their money. Okay? So there's an opportunity to make outsized returns, but the downsides are also equally pronounced. Okay? And that's what we mean by when we say derivatives are highly leveraged. Because derivatives basically allow you to do the equivalent of Investor 2. Okay? Investor 1 would go out, buy Amazon stock. Spend $200, buy one stock. Investor 2 would go out and buy call options, and I haven't just gotten onto call options yet, but they would buy 10 call options. If Amazon stock goes up by 10%, Investor 1 makes 10%, Investor 2 will make a lot more. The downside is, if the Amazon stock price goes down, Investor 2 gets wiped out, loses all the money. Okay? And number 3 here is not important. I put it down there just to kind of extend the argument. Nobody does this, but there is something like you could consider subpar leverage. Okay? So in this case, you have $1 million. You only invest half of it in the house. Maybe your friends or your parents put in the other half. So you've got 500K invested in the house, 500K sitting doing nothing. Okay? House prices goes up by 10%. Now you make 10% only on 500K. Okay, so your return on your total 1 million is only 5%. But your losses are more controlled as well. Okay, so that's kind of a subpar leverage. It happens sometimes. Some funds operate this way. They keep cash aside on purpose. But it's not something I want you to think about too much for this course. One more definition. Short selling. It's a means to make money when prices go down. Okay, so making money when prices go up is something you all understand. You buy a stock, price goes up, sell the stock, you make a profit. Short selling is just basically the opposite. You make money when the stock price goes down. Or I should stop saying stock. It could be any asset, right? Whatever it is. Short selling is a strategy that makes money if prices go down. Now, how does that work? Now, the way it works, you need to sell the asset, but you don't have the asset. Okay? Let's talk about the long strategy first. If you want to do the long strategy, you need to buy the asset, right? And hope that it goes up. How do you pay for the asset? You need $100 to buy the asset. Where would you get $100 from? You go to the bank, right? Bank would lend you some money. Go to a bank, borrow $100, buy the asset, price goes up, you make money. Now you have to pay a little bit back to the bank as a loan, as interest. That's okay. What about a short sell strategy? You need to borrow the asset from somewhere. Okay, and there's a big market in this. You go to someone, you borrow the asset. They lend it to you with the strict understanding, legally binding, that you will return this asset in the future at some date, right? 1 year down the line. But for that year, it's yours. You can return it earlier, but in a year, they want their asset back. They're lending it to you for 1 year. It's a loan. You borrow the asset, you sell it. Okay, so let's say the asset price is at 100. You sell it, get some cash. Asset price goes down to 80, you buy it back. Okay, where you need $80. Where do you get the 80 from? From the sale, right? From the 100 that you've sold. So you sold it for 100, you buy it back at 80, make $20 profit. Okay, that's the short sell strategy. Now the person who lent you the asset, and this is not important, I'm just going to close this off. The person who lent you the asset didn't do it for free, right? They'll probably ask you for some interest equivalent back. Okay, it's exactly the mirror image of borrowing money and having to pay interest. Now you're borrowing the asset, you've got to return the asset plus a little bit, you know? That's the service. But that aside, that's the short sell. And this is important because Black-Scholes is all about buying and selling stock, being long and short at different times. That's the strategy. And we will get into the habit of just saying long, go long the stock, go short the stock. And it sounds very simple, but every time you say go long the stock or go short the stock, all this is happening. Okay, it's happening under the hood, but I want you to know what's happening. All right, let's talk about some common derivatives. And I say common, but maybe a better word is vanilla. Vanilla derivatives. And I'll talk maybe about sort of semi-exotic. Exotic proper will come much later in the course. But for now, let's talk about vanilla derivatives. First I want to talk about is a forward contract. Just out of interest, so how many people here have come across financial derivatives? Okay, how many people here have kind of looked at forward contracts, call options, put options? Okay, some of you have, and that's okay if you haven't, because we're going to go through it in detail now. Okay, and if you need a little bit more time to get the idea cemented in your mind, just spend some time reading, either from the reading material or one of the textbooks that I mentioned. They all cover this extensively. So forward contract, we'll start with the simplest one, but also one of the most commonly traded. Okay, and a forward contract, it's a derivative that's written. Okay, that's a word. Written is basically means it defines what the underlying asset is, right? It's written on some asset. It's written on stock XYZ, or it's written on oil commodity. It defines a maturity. Okay, so there's a time horizon beyond which the derivative doesn't exist anymore. Okay, so that's another thing about derivatives. They have a shelf life. Once you get to the maturity of the derivative, the contract ends. That's it. Beyond the maturity, no more contract. What happens at maturity? So you have two parties, the buyer and the seller. Okay, so the buyer is contracted to buy the asset for K dollars. Right? Whatever the asset is, let's assume it's a stock. Let's assume it's a stock that has value $100 today. Okay, just an arbitrary number. The forward contract is a contract that's signed by the buyer and seller, where the buyer is contracted to buy this asset at at some number K in the future, and the seller has to sell it for K dollars. Okay, it doesn't matter what the underlying stock or asset is trading at in a year. K is something that's agreed today. Okay, so the underlying asset is $100 today. Nobody knows what it's going to be in a year. And yet, The forward contract fixes that value K that will be used to transact in a year. Okay? So if the underlying asset at time T in a year, if it's greater than K, the buyer wins. I say wins because the buyer gets to buy this asset for K. So let's put some numbers. Let's say S0 is 100. K is also 100. And let's say ST is now 120. So the contract buyer gets to buy this asset, which actually costs 120. They get to buy it for $100 at K. But if the opposite happens, and again, we don't know what's going to happen in the future. The underlying asset is random. But if it's less than K, then the seller wins. Because the seller gets to sell it for $100, even though everybody else in the market is selling it for 80. Right? It's contractually binding. So that's the contract. And the idea is that we set K today. Okay? And equally important, well, before that, why would anyone do this? Why do people do this? And it really comes down to financial planning. That's all it is. Buyers of the contract, they want to know how much it's going to cost them to buy something in a year. They need financial planning. Okay, they need to manage their finances. So if you're an airline company, you need to know how much it's going to cost you to buy jet fuel in a year so that you can plan your accounts accordingly. Okay? If you're a seller, you want to know how much profit you're going to generate. Okay? You want to lock in some profit, and that helps your financial planning. You know how much money is going to come in, you know how much you can invest in other projects. Right? So all that you're achieving here is that both parties gain some sort of certainty about the future to help their financial planning. Okay? That's why these contracts exist. Now, going to the question of what K is. K is not arbitrary. Okay? There's a tendency you might think, well, the asset's 100 today. It's been going up recently. I think it's going to go up some more. I think in a year, it might be 120. I think K at 120 sounds like a good number to me. That's not what's going on. Okay? K is not arbitrary. K is computed scientifically. Okay? That's the financial engineering. And we'll see that in the next slide. So there is science in how we get to K. Another thing I want to introduce, the idea of a payoff diagram. Payoff diagram just tells you at maturity, at time T, what's the contract position, what's the position of the contract holder. Okay, and you can see here, for this payoff function, can anybody tell me what K is? 100, yeah? So at 100, if this is the payoff here, at 100, you're 0. Right? That means that K is 100. If K is 100, and S is also at 100, you get 0. This is the case earlier on where I said the buyer wins. This is the case where the seller wins. This is all from the perspective of the buyer. So it's a payoff diagram. It just tells you, at the end of the day, what is the value of your position. And if it's positive, it means you've made money. If it's negative, you've lost money. Okay? You've achieved financial planning, but compared to the market, you're either doing better than the market or worse than the market. At this point, you're very happy because you locked in a cheap price. Here, you're probably kicking yourself. You're thinking if you just waited, you could have bought it on the market cheaper. But you'd have lost out on the financial planning. Okay, so this is a payoff diagram. Okay, we'll come back to what K is in a few slides when we talk about the deep dive. The other option is a call option. I think a lot of you put your hands up. Now this is a contract. Again, there's a buyer and a seller. But now the contract is an option. Okay, the buyer has the option to buy the contract. In the case of the forward contract, no choice. Contractually, you know you've got to buy the underlying asset at K in the future. Here you have the option to buy. Okay? You may decide not to buy. Okay? You specify K, which is called the strike. Now this is a very different, I think I probably shouldn't have called it K, but all the textbooks do. Remember, K here was something we had to decide today. The science, which we'll see in a few slides, tells you what K is. In contrast, for the call option, K is a contract specification. Right? The client tells you what K is. Client says, I want to buy Meta stock at 600 in a year. It's about 700 today. Okay, I want to buy it at 600 in a year. That's K. T, capital T is the expiry. That's 1 year. And in this case, once again, if the underlying asset in a year is more than 600, the buyer wins. Right? They get to buy something at $600, which costs more than 600 in the open market. Okay, so the payout is written according to this mathematical formula, because if the underlying asset is less than K, well, they won't buy it for 600. If it's trading at 500 in the market, you won't buy it for 600. You let the option expire. Okay, but if it's trading at 800, well, you're $200 in the money. Okay, that's the language we use. The difference with a forward contract also is that the buyer must pay a premium for this contract. So today, in the case of the forward contract, there was no exchange of capital, nothing. You just signed a contract. All the exchanges happen at the end. With the case of a call option, the buyer has to pay a premium. So you pay for the option today, right? This is where the leverage comes in. I mentioned earlier on. Instead of spending $100 on one stock, you spend $100 on 10 call options. Maybe they each cost $10. But that's it. That money's gone. You've bought the asset. If it expires worthless, you've lost all your money. Okay? And once again, that premium is not arbitrary. There's a tendency to think, well, this commodity, this asset, it's been going up. I think it's going to keep on going up. I think this option is going to value, really, it's really going to make a lot of money because the stock's just going up and up and up. I think it should be quite expensive. Turns out it doesn't work that way. There are scientific formulas which determine what the premium is. Okay? The Black-Scholes equation is an equation that tells you what that premium is, scientifically. Okay? And it turns out it doesn't matter what you think might happen to the stock. The science takes away all of that bias. Okay? So that's the payoff of a call option. Again, strike at 100. If the underlying asset is at 120, we say you're $20 in the money. The value of the contract is $20 because it allows you to buy something at $100 that would cost 120 otherwise. So really, if you're in this position and you have this call option, you buy the underlying asset at 100 and you sell it at 120 on the open market, you make your $20 profit. Right? That's what this payoff represents. There's no such opportunity here because you're out of the money. Okay? I'm going to skim through the put option because it's basically just the mirror image. Okay? The put option entitles the contract holder to sell the underlying asset at some strike. So now if you think prices are going down, if you think prices are going to go down, let's say the stock's at 100 today, you think it's going to go down to 50. It's just going to crash. You buy a put option to sell the stock at 80. Okay? In that case, this is the payoff. Right? It's just the mirror image of the call option. If the price goes down to 90, you have an option to sell it at 100. You can sell something for 100, which would otherwise, which other buyers which would otherwise only get you 90 on the market. So you get $10 profit. Okay, that's the put option. Let me pause a minute. Why would anyone buy this? What's the point? Why would anyone do a put option? I mean, sure, if you think prices are going down, etc., you might do it. But can you think of a bigger reason why this market, the market in put options, is so big? Yeah, downside protection. Elaborate a little bit. For who?
For the buyer, because if the price goes down, you get something, but if the price goes up, you can technically lose anything but the fee.
Correct. That's 80% of the way there. The people who normally buy these put options are people who already own the stock. Okay? They're investors in the stock market. They're waiting for prices to go up. Pension funds, insurance companies, they're all invested in the stock market waiting for prices to go up. The disaster scenario for these guys is if there's a stock market crash, prices go down, they lose a lot of money, all their investors are upset, they go out of business. They buy put options, it buys, as your colleague just said, downside protection. If there's a stock market crash, well, they make some back, right? It's not all disaster. That's really why we have the market in put options. Okay, it's downside protection. Any questions so far? No? The other idea is this concept of American versus European options. So in the examples I've mentioned so far, we've had a very well-defined expiry date, right? That's what I called capital T. Very well-defined expiry date. When you decide whether you want to exercise your call option, you do so at time capital T. An American option is kind of a more flexible version. It allows you to exercise at any point in time. Okay? So imagine this. You've got a call option, strike 100. Let's say that you've got a call option, the underlying asset is at 100, strike price is at 120. Okay? 100, 120. So your payoff is basically there. Price goes up, and this is a 1-year expiry. Something happens in the next 2 weeks, price goes up to 150. Right? Something else happens, it crashes down to 80. In a year, it's at 75. You don't feel so good, right? Because you made the right call, just the timing was off. With a traditional European call, all that matters is the price at the end in a year, at which time it's 75. With an American option, you could have exercised at that point where it hit 150. Okay, that's the difference. American option gives you more flexibility on when you can exercise. Now, theoretically speaking, mathematically speaking, continuous time, you can exercise at any point. You can ring your broker up at 3 in the morning and say, I'm calling the option. Okay, realistically, that's not how the contracts trade. We have this feature called the Bermudan feature, where the exercise dates are a bit more regularized, right? Friday, 5 p.m. every week, for example. Okay, it's still better than the European option, but not quite so unrealistic as the American option. Okay, so we will cover American options in this course. They are very complicated, but we will talk about them. Okay. Next one is the binary option, also called the digital option. Are people comfortable with the indicator function? Right? The indicator function is just something like this. It's equal to 1 if x is true, 0 for x is false. Okay, so x is a Boolean. That's the indicator function. It's a step function. And the binary option says you get $1 if the underlying stock is over the strike. It doesn't matter how far over the strike it is. It could be $1 above the strike. It could be $100 above the strike. You still get $1. Okay? Otherwise, you get 0. So just to show you the payoff, this is what it looks like. For a call option, 0, like we had for the European call, and then there's a step, right? Just jumps. Put option, exactly the mirror image, it's a step. Can anybody think about why you would trade this? If you can trade the call option, what does this give you over the call option? Any ideas? Perfect, perfect. If you're an investor and you think, the price is going to go up, but I don't think it's going to go up that far. Okay? Let me superimpose the payoff of a call option. Okay? If the asset's here today, you think it might go up to 105, call option earns you, whatever, $5. This one earns you, this is probably, you could scale it up to 100. You could buy 100 of these guys. But for a small move, you can get a much higher profit. Okay? Binary option pays out, is triggered on small moves. Okay? So if you think prices are going to go up, but maybe not that much, buy the digital call. Digital put, the other way around. Okay? All right, barrier options. So everything I covered so far is the vanilla space. These are semi-exotic. We're starting to get a bit more complicated. Okay? And the barrier option is what, it has this feature called the path dependency feature. Okay, path dependency means it doesn't own, the options we've looked at so far only care about the price of the asset at expiry, right? The path dependency feature means that the derivative pays off not only based on where the asset ends up at expiry, but the path that it took. Okay, what do I mean by that? If you keep track of the maximum price and the minimum price that the asset has ever taken, and let's call that little m and big M, okay, then the barrier option, the call, the knockout call, okay, I'll just explain it mathematically first and then we'll talk about what it means economically. Everything up to here is vanilla call, okay, we've seen that already. Asset, price minus strike. This is the indicator function which says that you're only triggered if the maximum value that this asset takes over the life of the trade never goes above B. Okay? Never goes above B. In other words, if the asset price rises too much, you get knocked out. Small moves are good, big moves not so good. Okay? Once again, this is for investors who think prices will go up, but maybe not that much. Okay? So then ask yourself this question. Why would an investor buy this? If you are of that view that prices will go up, but maybe not very high, why would you rather invest in the barrier knockout rather than a standard call? Say again? I'm not sure I follow. Can you elaborate? Sorry, I didn't get it. You, okay, yes, maybe. We haven't spoken about that yet. It's a bit more advanced, more simplistically. Cheaper. Exactly. Why is it cheaper? Yes, exactly. It's baked into it, this disadvantage. That's perfect. This is a disadvantage. If you didn't have this tells you the sky's the limit. Prices go up, you make money. This feature says, well, if the prices go up too much, actually you get knocked out. You get voided. It's kind of like it's working against you, right? So this option must be cheaper than the vanilla call. So if you're an investor and your view is that the price will go up, but maybe not astronomically, then this... Yeah. Someone just mentioned something. If there's a mean reversion feature of this to this asset, and mean reversion, we haven't talked about it, but mean reversion means tendency to come back, right? So large moves have a tendency to get pulled back. If you believe your asset is mean reverting, this is a great deal, right? Because you know this will never trigger, or you believe it will never trigger. And you get to invest in your idea at a cheaper premium. Okay? All right, so we've seen some vanilla options, but what you can also look at is linear combinations. Okay, so what typically might happen is a client will call the bank, says, I've got an idea, I need a derivative that's going to pay off this guy, this funky payoff. What's the price? And you look at it and you think, okay, this is, where do I even start? Okay. Well, actually, if you decompose the payoff, right? This is the payoff that will come through. We've already seen that component. Step looks like the binary. And what's left over looks like the call. Okay? So this payoff is just a linear combination of two things that we've already looked at, two things that we understand. Okay, so it always makes sense when you're dealing with a new payoff diagram, draw it out. And think about whether it's nothing more than just a linear combination of things you already know. Okay, in this case, it's just a combination of some digital calls and a vanilla digital call. Okay? All right, any questions on payoffs or any of the options and derivatives that I mentioned? I want to move on to, actually, that's a good place to stop. Let's take a short break. Back in 10 minutes at 10 past 9. Okay, let's talk about the time value of money. This is a critical idea in finance. Economists refer to it as net present value. Accountants call it net present value. Economists talk about discounting future cash flows. It's really all the same concept. In quantitative finance, we will use something called the money market account, which I will introduce in the next slide. But before that, I want you to ask yourselves or be aware of something that you probably have experienced already, which is that the value of money doesn't stay the same. Right? $100 today is not the same as $100 in the future. And $100 today is not the same as having $100 10 years ago. Okay? There's an inherent sort of devaluation of money with time. Okay? The time value of money is a concept that incorporates that into all of our computations. All right? And the way we keep track of it is through this money market account. Now, I don't know if you've ever asked yourself as to why the value of money doesn't stay constant. And it's all to do with inflation. Right? You all see inflation, you've experienced inflation, we all know it exists. What's not clear is why we have inflation. Okay, maybe it's not something you've thought about. For the economists in the audience, it's probably something you have thought about, but it's not something that if you've come from an engineering or mathematics background, I would imagine you've really thought about too much. Okay, and we won't talk about it now, maybe at a later lecture. But the point is that if you just accept for the moment that inflation is a fact of life, okay, that means the value of your money is going to be eroded, and that there is something called interest rates which compensate you for this erosion, then you can accept that the value of money has to change with time. Right? It's a consequence of just these two statements, that there is inflation and interest rates kind of compensate you for loss due to inflation. So the value of the time value of money is a consequence of those two statements. Okay, so how do we do it? If you invest $1 in a bank account and just watch it grow, that's one way of tracking the time value of money, because it's the same $1. Right? You haven't put any more in, it hasn't done anything, it hasn't worked. You've just put it in a place and it's grown according to whatever the fair value of growth is. Right? That's the time value of money, the growth, the fair growth of money. Now we have to caveat it. We're assuming here that the bank account, whatever this bank account is, the money is always there. Right? You can access it freely. There's no risk. There's no chance that the bank defaults. Okay? And you're basically safe. If you call this an investment, it's as safe an investment as can be. Right? Now these are approximations, and we've seen examples in the last few years where both approximations have been challenged. Okay? Every time you hear about a run on the bank, it's this idea that people don't believe that they're going to get their money back, and they want to withdraw. They're all running away from the bank. But that aside, we're going to assume that there are no liquidity considerations. The bank is safe, the money's always there. If you want to add to it, you can. If you want to withdraw, no problem. So it's risk-free and there's no chance of the bank defaulting. Okay, that's the model. And again, the money market account is a model. It's a representation, as I mentioned earlier on, it's a representation of the real world. Okay? And I'm going to add some more assumptions, some more approximations, or some more definitions into this model. I'm going to assume annual compounding. That means you get interest on your capital once a year. Okay? So in a year, if the interest rate is R, your capital grows by a factor of 1 plus R. If you invest $1, in a year it's 1 plus R. In year 2, 1 plus R squared. 1 plus R to the third, 1 plus R to the T after T years. Okay? That's what we call annual frequency. There are some formalities in terms of what is a year. Is a year 365 days? What about leap years? is a year just 12 months, where each month is 30 days. These are all approximations we can make. Well, they're not approximations. They are specifications that have to be made explicitly, okay, so that you know exactly how your interest is accruing. Okay, but that aside, this concept of day count convention, you can read up about it. For this program, you only need to worry about two: actual 365 and 3360. Okay, and in any question, either in an exam or in a homework assignment, I'll always make it clear which one we're talking about and which one you should use. Okay, but that aside, that's all there is to it. Okay, that's very simple geometric series. That's the money market account for annual compounding. Okay, what about semi-annual compounding? I mean, that's perfectly valid. We can assume that a bank exists out there, which instead of paying depositors every year, pays them every 6 months. Okay, and let's say they offer S% interest. And now, instead of accruing over a whole year, you accrue in the first 6 months. That's the S over 2. There are 2 6-month periods in a year. That's the 2 up here. And everything else just follows naturally. Okay, it's very straightforward. At day t, at the end of the term, it's 1 plus S over 2 to the power of 2t. The 2 reflects the frequency, right? We're semi-annual compounding, which means in 1 year there are 2 compounding periods. Okay? Sorry, this is incorrect. Semi-annual. The idea of day count convention is still a valid question, but that aside, that's the formula. Okay, so I've given you 2 models, but that's arbitrary. You could have any frequency you wanted. There's nothing stopping a bank offering customers quarterly interest, monthly interest. Whatever the frequency is, that's the formula. Okay? And this is a formula you should understand. You should understand, you should be able to derive it, but there's no derivation involved. It's just, if you follow through the logic of the geometric series, that's what you get. Now, that's not what we're going to use. Okay? This is to build the idea towards something called continuous compounded interest, which takes the limit of f to infinity. Think of it like daily interest. Your bank pays you daily interest. And the maths falls nicely, because if you take the limit of f going to infinity, and you remember that that's the Taylor expansion of the exponential function, we have this identity. Okay? And that's what we call the continuously compounded money market bank account. Okay? Now here's a question. What if in your economy, or in your model, because again, the model is the representation of the real economy, you had 2 bank accounts. One which paid R, annual, one which paid S, semi-annual. Is there a problem? Somebody said standardized. Yes, there has to be an element of standardization, but what's the problem? If I say R and S, do you need to impose some condition on R and S? And the answer is yes, you do, because think about the perspective of an investor. R and S are 2 numbers which are known. That's what the banks advertise. But imagine all you care about as an investor is how much you put in, how much comes out. And let's say you have one bank account which accrues from 100 to 105. Whether it's annual or semi-annual, it doesn't matter. All you care about is what you get back in a year. The other bank account accrues from 100 to 104. Where's the arbitrage? Perfect. Okay? So you've just constructed a model which admits arbitrage. So the model's no good. So in other words, you're perfectly free. I'm not saying you can't have S and R. I'm saying S and R have to be picked very carefully so that both these bank accounts are consistent with each other. Okay? And if that's the case, your model's good. Okay? So S, R, continuously compounded R, they all have to be consistent with one another. If you invest in either of them, you should accrue at the same rate. That is to say, in a year, the balance has to be the same. Okay? That is a well-formulated money market account. And when you realize that, you realize, well, I don't need to bother with R and S and semi-annual and annual. Let me just pick one. And I will always assume I can move from one to the other by some formula, and you'll get a chance to practice that in the homework exercise. But you only need to stick to one. And the quants, in their wisdom, decided to go with the continuously compounded money market account. Okay? That's the one. That's the one that's going to come up again and again and again. When we look at the Black-Scholes model, we're going to assume there exists a continuously compounded money market account. Okay? Any questions on that? It's a central idea, because it leads nicely onto the first derivative pricer. Okay? And this is going to introduce one of the key concepts that will come up again and again and again for the next 13 weeks. So here's a very simple derivative. The first derivative you're going to price. Here's a contract which pays exactly $100 in 2 years. Okay, I'm giving you a contract. It entitles you to $100 in 2 years. Come back here in 2 years, you get your $100. How much would you pay for this contract? How much would you pay? Well, let me ask a simple question. Would anyone pay $5 for this contract? You pay $5, right? Seems like a good deal. Pay $5 today, you get 100 in 2 years. Okay? We're ignoring the possibility that I might run away, that I might steal the money. Let's put that all aside. Assume I'm good for it. You get $100 in 2 years, you do it for $5. Would anyone do it for $105? No. Right? You're not going to pay $105 only for me to give you $100 in 2 years. So there are some limits. Right? There's a price that you would definitely do it at. There's a price that you definitely won't do it at. So where are we in the middle? There's somewhere in the middle. There's got to be a sweet spot which makes just the right amount of sense. Okay, so that's the derivative. And we're going to come up with this price scientifically. Okay? And this is how we're going to do it. We assume we have the bank account, the one I've just introduced. It doesn't matter if it's continuously compounded or annual, whatever it is. I think I'm going to use annual. We have some day count conventions, so we know that 1 year means exactly 1. 2 years means exactly 2. That's what actual 365 means. Okay? And here's the critical idea, which is to use something called replication. Okay? The idea of replication is to reprice the value of this derivative. Remember, the derivative is very straightforward. Just be here in 2 years and you get your $100. That's all it is. So the idea of replication is to be able to independently synthesize the payoff using some other market instruments. Okay? And the idea is then, if you can independently synthesize this contract using these other instruments, the value of assembling these instruments today has to be the value of the contract price. Okay? This is again a natural extension of no arbitrage. So let's see how we do it. This is the replication strategy. So you buy the derivative for value P. We don't know what P is. Okay, that's what we're trying to work out. Now I've sold you this contract. You've just given me P. You've given me cash. What am I going to do with that cash? In this model, I can't go out and spend it. because my model has only one thing in there. It's the money market account. There's no Amazon stock. There's nothing like that in this model. This is the most simple model. So at time t0, which is today, I invested in the bank account. Okay? And I end up with this in 2 years. That's what we've seen in previous slides. Yeah? And my claim is that this has to grow to 100 in 2 years. Okay? If it's anything else, there's an arbitrage. Okay, so I can easily solve this. R is given. We know what the interest rate is. Put it on the other side, I've got the value of P. Now the question you need to ask yourself is, well, what if I sold you this derivative? So let's say P comes out to $90. Okay? I sneakily sell you this thing for 95. What's the problem? What would I do? I would take $95, I'd put it in the bank account. It's going to grow to more than 100, right? By definition, because we know that P equals 90 grows to 100. So I end up with more than 105. I end up with more than $100. I give you your dollars, your $100 in 2 years, and I keep the rest. And that's a pure arbitrage profit. Okay? If it's less than 90, if I sell it to you for 80, I've locked in a loss. I would never do that. Right? So there's the sweet spot. 90 is the sweet spot where it makes sense for both parties. And no party makes money. Okay? You get a contract, I replicate it, and that's it. It's a prescribed scientific formula. Okay? That's the first derivative pricing. Now the question is P unique? What if I also had a bank account that pays semi-annual instead? Do you think P is unique? P has to be unique, right? If it's not, you've got the same thing. You can play two contracts off against each other. If somebody's willing to sell it for 80 and somebody's willing to sell it for 90, you just play them off against each other. So P has to be unique. Never mind that you've got a different bank account, because remember what I said earlier, even though S is a different number, it's precisely that number which grows to 100, in this case, in 4 periods. Okay, that's the consistency between the two money market accounts. If you didn't have that consistency, you would have admitted an arbitrage in the pricing of this contract. Okay, so P has to be unique. And by the way, this is an introduction to the first pricing, but this is going to come up all the time. All the time we're going to need to know the net present value of some known cash flow, or later on, unknown cash flow. The fact that it's unknown doesn't change anything. It's still a cash flow, and you need to represent its present value. Okay? So this is going to stay with us. The idea of discounting time value of money, that's going to stay with us right till the end of the course. Okay, so I want you to be very clear about where it comes from. Any questions on any of the material? Because I'm going to get ready for the case study. We're going to talk a little bit about forward contracts. Nothing? Okay. Forward contracts. So I've already defined it. And just to remind you, this is a contract where the buyer is legally obliged. Okay? There's no choice, no option, to buy an asset at maturity, a year down the line, for some predefined price K. Okay? The underlying asset will be at some price in a year. We don't know what it is. It's random. But we're going to fix the price K today. Okay? And the question is, what is K? And once again, we're going to use the idea of replication. But this time we have two instruments in our model. We have the money market account. That's always there. Okay? From now onwards, money market account is the first thing you put into your model. The second thing you have is the asset itself. Okay, so you have the bank account and the asset itself. And the replicating strategy is as follows. At time 0, that's today. So I'm the seller, you're the buyer. Okay, I've agreed to sell you this asset in a year for K dollars. So what am I going to do? Well, I'm going to buy the asset right now because I know I need to give it to you in a year, right? Remember, there's no choice. Contractually, I have to sell it to you in a year. So I might as well go out and buy it today. Cost me S0 dollars. S0 is the value of the asset. I need that many dollars. Where do I get that money from? Borrow it from the bank. Okay? So I borrow it from the bank. At the end of the day today, I basically have the asset because I bought it, and I got that cash to buy it by borrowing from the bank. And that's what I'm calling here short cash. I've taken a loan, so I'm short cash. And that's it. I wait. I hold it until time T. I hold it for a year. In a year, the asset price has done something. I don't know what it's done. It's gone up, down. I don't care. I don't care because I need to sell it to you immediately. That's the contract. So I surrender the asset to you, and I receive K dollars. The same K that we agreed right at the beginning. Okay? But that's not the end. So I've given you the asset. I've got my K dollars, but I still have a loan. I need to repay back the loan, right? I borrowed S0 to pay for the asset in the first place. And that's this part here. I need to repay the loan. So I've got the K dollars that you gave me minus what I need to pay back for the loan. Question is, what is this? What does it have to be? Zero is a good number. It has to be 0. If it's anything more than 0, I've just created an arbitrage opportunity. If it's anything less than 0, I've locked in a loss. Okay? The sweet spot is 0, which means we can just compute K, because that's known. We know that. We know that. That's part of our model. We know that. That's part of the contract. The only thing we don't know is this, and we know that the whole thing has to be 0. And there you have it. That's the price. That's the forward price. If I had sold it to you for anything more than that, this would be greater than 0, and the difference, that amount, would be my arbitrage profit. You see that? So let's take it a step further. This was a stock. Some stocks pay dividends, right? Some stocks pay dividends. So let's consider the case of an asset that pays a dividend. Same thing, same replicating argument. At time 0, borrow some cash from the bank, buy the asset, and hold until time T. The difference now is that over the time, from now to next year, this stock is going to accrue, is going to pay some dividend. Right? So I'm going to get some cash flow coming in. So I do my accounting, and at time capital T, I still surrender the stock. I still give it to you. You're not entitled to the dividend, right? You only get the stock at time T, and you get dividends from time T. Any dividends before that are mine, because I was holding the stock. So, I give you the stock, I receive K, I've earned some dividend, and I need to pay back the loan. So my total position is now this, exactly the same except for this difference. Okay, so the formula just adjusts itself. Now, if I had priced this ignoring the dividend, Where's the arbitrage profit? Can anybody tell me what precisely the arbitrage profit would be? Be the dividend. Exactly. It's the bit I didn't factor in, which is the cash I'm left over with at the end, which is risk-free. Right? So dividend-paying stocks will come up. We'll talk about them when we talk about financial modeling of stock prices. It also comes up in FX. Okay, it's not obvious at the moment, but FX, foreign exchange, has this idea where there are two currencies involved and both have their own interest rates. So it turns out that one of the interest rates, the foreign one, acts as a dividend, kind of. Okay, so dividend modeling is important. It comes up in many, many different guises. All right. So you've seen a little bit of pricing. Okay, so you've kind of started looking at pricing, replicating, derivative payoffs. One thing you need to be mindful of is don't just accept any number you get. Okay, when you do your maths, think about whether the output makes sense, because there are some limits on arbitrage pricing. Okay, arbitrage, once you get your head around it, makes you realize that some numbers simply can't be right. Okay, some values simply don't make sense. Forward contract, we talked about K, we talked about how we derive K. It cannot be, K can never be less than S0. Okay? Exercise to convince yourself. Okay, go through the derivation, the replicating strategy, and think about what would happen. What would be the implication if you sold the derivative at a forward price less than S0? And you'll see that there's an arbitrage in there. Okay, call options have to be greater than 0 in value. Why? What if it's negative? What if a call option price is negative?
Just buy limitedly and hope if price goes up, I just
Yeah, I mean, what happens when you buy it?
I collect money.
Correct, right? If it's negative, that means somebody's paying you to take the option. Right? Doesn't make sense, because you get paid to take the option. Worst case scenario is that it expires worthless. So you make money on the premium. Best case scenario, it expires in the money. You make money both on the payoff and when you bought it. Okay? It doesn't make sense for it to be negative. It's very obvious. But at some point in your career, you're going to be writing the maths, coming out with the numbers, and you come up with a number which just doesn't make sense. Okay? This one is less obvious. The value of the call option has to be less than the value of the stock. Okay, that's another exercise for you. Think through the replication. What is the implication if somebody is selling a call option at a price greater than the value of the stock? Well, if you can sell it for a value greater than the value of the stock, that means you can go out and buy the stock and still have money left over. Okay, and if you've sold the call option, that means one day somebody might come to you and ask you to buy back the stock. But it's okay, you've got it. Because you bought it right at the beginning and you kept some profit left over. Right? So some values don't make sense. Put options, the first one is obvious after it's the mirror image of the first one. Maybe this one is less obvious, so maybe I want you to think about that one. Think about why it has to be less than K, the strike. Okay? Another one, we talked about barrier options. Somebody already mentioned that the value of the barrier option has to be less than the value of the non-barrier counterpart because it's more restrictive. Okay? That's another limit. If you come up with a price and you realize, hang on, it's worth more than the vanilla put, which comes from Black-Scholes, well, there's a problem. You've done something wrong in your modeling, you've done something wrong in the maths, bug in your code, something's off. Okay? Okay, last concept that I want to introduce is the idea of put-call parity. So I'll introduce it today, but we're not quite ready to understand it in tremendous detail. I think once we look at the Black-Scholes formula, we'll come back to put-call parity. For now, just look at the payoff diagram. Okay, payoff diagram for a call, long call. What's the payoff diagram for a short put? How would I draw that? Comes up here. Put would go up normally, right? Long put. Short put would go down. And that's nothing more than ST minus K. Right? If you do the maths, you'll see. It's basically ST minus K. The y-intercept is minus K. Okay, so this thing looks very complicated. A call and a put. I mean, we haven't talked about what the value of a call and a put is, but we know what it looks like at expiry, and it turns out to be this very simple linear function. Okay? And it turns out that if it's true, if this relationship is true at the expiry of the option, it has to be true at any time before that. Okay? If not, there's an arbitrage. Okay, so what's the value on the left? Well, the value of a call option at time t0, let's just call it c0 and p0 for the value of the put options and the call options today. Let's say we get them from somewhere, doesn't matter where. What's the value of this today? That's the simplest derivative. The asset itself. Remember I said the derivative is a function of time and the underlying asset? What's the simplest function? The simplest function of f of t and x is x. Well, simplest function is constant, but in terms of a function that includes the variable, it's just f of x equals x, right? That's the simplest function. How would you replicate a payoff of s capital T at time little? How would you replicate a cash flow, a derivative that pays s of capital T? How would you replicate it today? Just buy the stock. Right? If you buy the stock today, you're guaranteed that you have s of t at capital T. Right? So if you want to think of s of capital T as a derivative, the value of that derivative today is just the value of the stock. Very obvious. Okay, but I'm trying to get you into the mode of thinking of it as a derivative as opposed to as an asset. Okay? And K, what's the present value of K? What's the value of a contract today which pays K in the future? Well, we've seen that already. That's the first derivative we introduced. It's K times this discount factor. Okay, so these are all concepts we've seen already, but the important point is that you have this very important relationship. Okay? If you're in this situation, the left-hand side has to equal the right-hand side, but if the left-hand side is greater, okay, and what does it mean it's greater? It means you ring up a broker, you ask him the call price, he quotes you something, you ask him the put price, they quote you something, so you know the value on the left. You look at the right, that's just basic maths. S0 is the number on the Bloomberg screen. K is the contract. E to the minus RT is just maths. You look at these two sides of the equation, you think, well, they should be the same, but they're not. The value on the left is too large. So what do? You short the one on the left, you long the one on the right. Okay? It's called a convergence trade. And you just wait, because you know for sure at time capital T, they will be the same. Right? You don't need a model for that. These are model independent results. Okay? It's a model independent relationship. So this is called put-call parity. And we will talk about it again. But for now, you can see, in terms of payoff diagrams, what it looks like at maturity, and then deduce that if it looks like that at maturity, you know what it looks like at any time prior to maturity. Another kind kind of parity relationship, the barrier call option or the barrier put option, I've introduced both. If you have a knock-in and a knockout, it's equal to the European. Convince yourself that that's true. Again, draw the payoff diagrams, think about the payoffs, think about when the knock-in pays out, when the knockout pays out. If you had one of each, what are you left with? Okay, you'll find out that you're left with the European. And this one, which we've already seen, which is the American option, is generally worth more than the European option because it gives you more flexibility. Right? European option, everything's determined at time capital T. American option, you've got a bit more chances to make your decisions. Okay, so it's worth more. These are all model independent relationships. Okay, and there's nothing better than having a model independent relationship because it means that you're working within confines that are independent of your maths, independent of the model you've chosen. Maybe you have a good model or a bad model, doesn't matter. These results are independent of model. They're fundamental rules that your numbers just have to follow. And if they don't, you know there's a problem. Okay, questions? Sorry, say louder. That is an excellent question. An excellent question. Absolutely you do. Right? I cheated. I simplified. I said derivative comes in and you just put it to one side. What our colleague is saying is that, well, actually the dividend comes in, I'm going to put it in the bank account, and that's going to accrue. But it can become very complicated because I didn't say when the dividend comes in. If you don't know when the dividend comes in, you don't know how to count the accrual of interest. But it's realistic, right? It's again, a model is a simplified representation of the world. The simplest thing is ignore it entirely. Bad. Because to first order, you're missing a component. Second thing is try to put it in, approximately. Pick a time that works. Maybe you want to be conservative. You assume it comes in right at the beginning. Right? And you accrue as much as possible. Excellent question. Any others? Okay, so Professor Daniel's in here, Dr. Daniel's in here next week. He will take you through the next 6 weeks. We will be administering the homework together. As I mentioned, attempt the exercises, attempt the labs, engage in the conversations. If you have questions, just post a note on Canvas. I will reply as much as I can, but it's good for you guys to also collaborate and work together in solving them. So I will see you in 6 weeks. Okay, thank you.